Good morning, everyone. Welcome from our NICAR CRE Broker Forum. This is a once a month webinar where we typically host some sort of content, and this being the beginning of the year, we like to have a forecast of what's happening in the Chicagoland area of all our asset classes. And then after the content, we have a networking or a needs and wants session. So the focus certainly is for brokers to bring on their client needs, or if they're a principal, what their needs are, whether it's buy, sell, lease. It doesn't matter, or need help with a problem. We try to give everyone in the room a chance. We do ask if everyone can stand when we're introducing to each other and help each other. So even if we're not going to be part of the deal, it's something that we could pay it forward, whether it's for ourselves, our clients, or we know another broker investor that we can introduce. We're here to help each other. So we aim to do this at the end of every month. If you can also put your name and email information or all your contact information, any links that you have or needs and wants in the chat, we do save the chat and you can bring that up. We do kind of store these needs and wants as we can through NICAR, always looking for improvement. And I am Teresa Mueller. I'm the managing broker of Trillium. I also am the chair for the CRE Broker Forum, as well as secretary treasurer on the executive board for NICAR. So always open to suggestions, whether it's for this webinar, NICAR, or you just feel like telling me about whatever. I'm always all ears. So Teresa Mueller, I look forward to hearing from you. And so today, for our webinar, we again are hosting Adrian. He is from CoStar. He has access to lots of analytics. In fact, if you're part of CoStar, you also have access to a lot of this data, but he is helping drill it down for us, simplifying it so that we have an understanding of what's going on in the Chicagoland area. He is a good resource if you have questions or want to figure out how to break apart some of the data in CoStar. Obviously, they have their sister companies, LoopNet, BizBuySell, etc. He can be a point person if you need. So he'll give a little bit more intro about himself. Thank you, Adrian. We apologize. We did try hosting this last week. We had an interruption. So hopefully it is without interruption today. And we have a great presentation. If you can please hold questions for the end, or if you have something a little bit more urgent and you feel like I should interrupt, go ahead and put it into the chat. And I will interrupt. I would appreciate if everyone has their screens off and are muted while he is presenting. Adrian, if you could please introduce yourself, give a little bit of background, and start, and I look forward to everything you have to say today.
Awesome. Yeah, of course. Thank you, Teresa. I really appreciate it. And good morning to everybody. My name is Adrian Brizuela. I'm the Associate Director of Market Analytics here at CoStar. So I cover the entire Chicagoland region across all property types, so office, retail, industrial, multifamily. A big part of my role is to make sure that what we're seeing in the data aligns with what's happening out in the market. So if you're and by doing that, keeping tabs with market participants and industry players. So if you ever have any questions as it relates to any of the content, news, or data or reports that you're seeing on the CoStar platform, specifically as it relates to Chicago, please feel free to reach out. I'd be happy to discuss in further detail. But today we'll be discussing our 2026 Chicagoland commercial real estate forecast. So that entails the entire Chicago MSA from Northwest Indiana up to Kenosha. So a brief agenda for today. We will kick it off with multifamily, and then we will go on to the worlds of industrial, retail, and office. And upon the completion of each property type, I'll provide a brief outlook for what to expect by property sector in 2026 and beyond. So without further ado, let's get started with multifamily here across the Chicagoland area. So taking a look at at supply and demand, in 2025, demand outpaced supply in the Chicago market, as the market absorbed about 6,500 units compared to the 5,400 units that were delivered. The uptick in recent demand is primarily due to increased net migration, and that's actually a trend that we're not forecasting to continue at the rate that it did in 2023 and 2024, as during this period, the Chicago MSA added just shy of about 100,000 people, primarily due to net migration. In 2026, we're forecasting approximately 5,000 deliveries across the Chicago MSA, with demand forecasted to keep pace with supply. Looking beyond 2026 to 2027 and 2028, we are forecasting deliveries to we are forecasting deliveries to decline even further, with approximately 4,000 each year. Taking a look at a time series of Chicago's inventory under construction. So as of the end of January 2026, there was approximately 10,000 units under construction across the entire market, and that accounts for approximately 1.7% of the market's total inventory. For comparison purposes, the national average is around 2.7%. And we saw development activity pick up in the second half of 2025 as we saw our percentage of inventory under construction go from about 1.2% to 1.7%. And that was due to about 3,500 units breaking ground and added to the development pipeline. Over the last decade, the market's averaged about 13,500 units under construction at any given time. So today's figures mark about a 25% decline in supply. And our recent outstanding fundamentals in Chicago can be attributed to what happened in 2021 to 2023. And that's that Chicago never overbuilt. Our percentage of inventory under construction peaked at around 3.2% in mid 2022. And at that time, the national average was slightly north of around 5%. And if you take a look at your high growth Sunbelt markets, such as Phoenix, Nashville, and Austin, all under construction. So taking a look at vacancy, so currently our vacancy across the MSA stands at around 5%, while nationally vacancy stands at around 8.5%. And over the last year, we've seen Chicago's vacancy rate tighten by about 70 basis points. So kind of notable tightening in recent periods. Looking ahead, we are forecasting vacancy to hover around 5% through 2026 as demand is projected to keep pace with supply. And nationally, similar story. We're forecasting vacancy to remain relatively flat as well, staying around the 8.5% mark. So taking a look at some vacancy data for the year end 2025, Chicago remained one of the tightest and most competitive rental markets nationally, with only metros in California and New York posting lower vacancy rates. Vacancy surged in the South and Southwest over the past couple of years due to oversupply, while most of your Midwest and Northeast markets saw only moderate increases in supply, resulting in more balanced fundamentals. And among the 50 largest markets, vacancy is highest in Memphis, San Antonio, and Austin. Taking a look at rent growth nationally, so for the Chicago metropolitan area, rent growth is around 3.3%. Nationally, that figure is 0.3%. So Chicago is outpacing the rest of the nation by a notable margin. Looking ahead, we have revised our rent growth forecast downward, both nationally and for the Chicago metro. However, the Chicago market is still projected to outperform some of these national figures. So for 2026, we're forecasting Chicago rent growth to hover around the 2% mark, while national rent growth is projected to remain relatively flat. The revisions to the forecast, they entail a wide range of factors, but we can attribute them to deceleration in population growth, as I mentioned, particularly due to declining net migration, in which Chicago was the beneficiary of in 2023 and 2024. Additionally, we're forecasting a decline in primary rental cohorts. So think your individuals aged 24 to 39. And then additionally, we've seen a decline in employment projections as well. And in recent periods, we've seen significant month-over-month rent declines. And all of these kind of create the perfect storm for an overall slowdown in demand or absorption. And the slowdown won't be negative, but definitely a decline from current levels. So kind of breaking rent growth down by our quality segments. So as I mentioned, market-wide, we're at 3.3%. Product actually leads all quality segments here in Chicago at about 3.7% year-over-year rent growth. And then your 1 and 2 star and your 3-star assets are going to hover near the 3% mark. And this is actually interesting. This is a shifting dynamic. As you can see, the 4 and 5 star is typically going to be your most volatile, as that's where the bulk of deliveries are concentrated. But the rent growth has been steadier lately, and that's just due to tenant preferences for premium amenitized product. Additionally, individuals renting for longer as a result of higher mortgages, kind of pushing them to that 4 and 5 star product. So to put our pipeline in perspective, the overall percent of inventory under construction compared to rent growth is kind of telling of the kind of the overall health and balance of the market. So Chicago currently ranks number 2 in rent growth across the top 25 markets by total inventory at 3.3%, again, outpacing that national average of 0.3. And kind of just zooming out long term, Chicago is ranked in the top 5 for rent growth across this set for 7 consecutive quarters now. And that's kind of a direct correlation to not overbuilding coming out of the pandemic. So nationally, the inventory under construction percentage sits around 2.7%. And if you slice the top 25 markets, that's the average there is 3.2%. Then if you refine that even further, if you take just the Sunbelt markets included in this competitive set of the top 25 markets, those markets average around 4.5% of their total inventory under construction. So taking a look at our rent growth forecast for year end, so we're projecting rents to be in Q4. So Chicago's forecasted about 1.8% year over year rent growth. Nationally, we're expecting that figure to climb towards 1%. And despite the forecasted deceleration in rent growth for Chicago, we're still outperforming by a wide margin. And additionally, we're forecasted to remain in the top 15 of the 50 major markets nationally. Taking a look at transaction volume. So in 2025, the Chicago multifamily market saw about $5.2 billion in total volume, which represents about a 34% increase compared to 2024. Nationally, the $120 billion in transaction volume in 2025 marked a 5% increase year over year. So a significant amount of liquidity here in Chicago and notable increase year over year. On average, you're seeing assets traded at around $228,000 per door in Chicago, and that's about a 7% increase year over year. And nationally, the average price per door is right around $230,000, and that increased by 2% year over year. So on the left side here, we have a heat map visualizing the concentration of multifamily transaction volume. As you can see, there's dense clusters in the downtown and north lakefront areas, with some of this activity extending into some pockets in the suburbs. So downtown Chicago led all submarkets with about $1.2 billion in transaction volume at an average of around $440,000 per door. And the North Lakefront trailed right behind it at about $1.1 billion. And assets in that submarket typically trade around $294,000 a door. The most active suburban submarket, aside from these top two urban submarkets, is going to be the Naperville Lisle area. And they had just over $430 million in total volume in 2025. And outside of the top three performers, Evanston has the highest price per door at $275,000 per unit. So what's next for Chicago? I don't have a crystal ball to tell you where interest rates or cap rates are going to be a year from now, but based on some of the data, we are expecting rent growth to moderate as a result of slowing population growth, slowing job and wage growth, and slowing demand. And that's not just for Chicago, but also nationally. And despite this less optimistic outlook, Chicago is still poised to outperform the rest of the nation, again, on the heels of limited supply and sustained demand. And the story around Chicago has been undersupply for quite some time now, and that'll continue to be the case. But at the same time, that's also easing up. In the second half of 2025 alone, the market added about 3,500 units to the development pipeline. And while I don't think we'll see an explosion of supply like some of your Sunbelt markets did in 2021 to 2023, I do think our percent of inventory under construction is going to remain closer to the 2% mark as opposed to that low 1% mark for the foreseeable future. Transaction volume is trending in the right direction. So liquidity is returning. As I mentioned, total volume increased by over 30% in 2025 compared to 2024. And again, I don't have the crystal ball to tell you, the exact interest rates or cap rates a year from now, but given our strong fundamentals and supporting data points, I would say that the market is trending in the right direction. And the $1 million question, across Chicago is, can Cook County figure out its property tax situation? So while the sentiment across Chicago does appear to be gaining traction, investors are still wary of property tax uncertainty related to Cook County. And that's not only how much will my tax bill be or how much will it increase by, but when will I get it, as the last 2 to 3 installments have come in a bit delayed. And that's all I have on the world of multifamily, and on to the world of industrial. So to kick it off, I'm going to start with a national trend that we're seeing that is impacting demand for space here in Chicago. So as a major inland distribution hub, Chicago relies on steady flows from the coastal ports. So when the import volumes slow, it translates to less demand for your warehousing, cross dock, and your last mile distribution space locally. So the recent moderation in port activity helps explain why we're seeing slower leasing velocities, rising vacancies, and more cautious expansion from your logistics operators across the Chicago market. So taking a look at supply, demand, and vacancy. So in 2025, Chicago's industrial market absorbed about 5.2 million square feet of industrial space, and that actually marks about a 40% decline compared to 2024. And a bulk of that can be attributed to slowing demand for your logistics and distribution space. From a supply perspective, the market delivered around 12 million square feet of industrial product, and similarly, that marked about a 40% decline year over year. As a result of supply outpacing demand, we did see vacancy spike by about 30 basis points to 5.7%. And while that is a notable spike, I think it's important to note that we're still around 180 basis points below the national average of 7.5 as it relates to vacancy. Looking ahead, we are forecasting a recovery in demand in the second half of 2026 and beyond. And that's just as kind of the market works through some of that existing supply that's currently out there sitting vacant. But again, this forecast kind of also depends on overall trade and policy stability. So taking a look at demand by subtype for industrial. So within the logistics space, we saw outsized gains in 2021 and 2022, but over the last year, absorption has been relatively flat to choppy and near zero. And there was actually a couple soft quarters, again, due to slower import flows, cautious inventory strategies, and a pullback in your big box expansions. Specialized performance, it was relatively uneven to slightly negative, and they did have two down quarters in the last year. And that's due to users in your manufacturing and processing spaces delaying their moves and right sizing their footprints. And that's just due to general cost pressures and uncertainty as it relates to demand. Flex was kind of modestly positive, but kind of subdued. The trend here is renewals and smaller expansions; those continue, but new demand is limited. And overall, Chicago's fundamentals are, I would say, that they're relatively resilient given our hub status as the number one industrial market by total square footage in the entire nation. But our demand profile is shifting towards renewals, smaller deals, and just generally longer decision cycles. So as it relates to our industrial supply, we currently have about 16 million square feet of industrial product underway, and that represents just about 0.9% of our total inventory. If you compare that to the national average, that rate is currently around 1.4%. Our current level of activity is a significant decline from the recent peak of supply in 2023. And during that time, there was about 40 million square feet of industrial space under construction at any given time. We did see a slight acceleration in development activity in the second half of 2025 as the market broke ground on about 4.5 million square feet of industrial product in the fourth quarter alone. And just generally, the supply picture in Chicago across the industrial space represents moderation from some of the all-time highs in recent periods and a recent uptick in activity as it relates to development. So taking a look at vacancy rates by subtype, we did see logistics vacancy nudge up through 2024 and 2025. It's now hovering near the 6% mark. And that rise reflects just slower freight flows, right sizing of safety stock, and sublease additions in your big box corridors. So think I-55 and I-80. And specialized space has historically been the lowest vacancy subtype, but that did inch higher over the past year. But it's still relatively tight to its peers, but just no longer at the prior troughs. And that's just due to manufacturers delaying expansions and consolidating their footprints amid, again, uncertainty over cost and demand. But the general takeaway here is that vacancy is kind of converging toward the the mid 5.5% range, and kind of just returning to a more normalized, slower growth environment coming out of the pandemic. So I think what you can expect to see here is more renewals, longer decision cycles, and moderating rent growth in comparison to that boom that we saw in 2021 to 2023. So taking a look at rent growth by subtype. So your specialized space is going to lead the charge for rent growth at 4.6%, and just indicating heightened demand for ongoing needs such as food processing, cold storage, manufacturing, and high-tech production. And again, these uses are a bit less exposed to your cyclical swings in comparison to freight, e-commerce, and distribution. Then we have flex space trailing at around 3.7%. And then we have logistics space that's currently lagging behind all subtypes with around 3% year-over-year rent growth. But something important to note that even in a period of significant deceleration in demand due to shifting economic policy, the sector still outpaces national rent growth by nearly 2x. And that's just kind of due to our importance to the broader industrial landscape nationally. And looking ahead, the general rent growth picture for Chicago, we are expecting it to decelerate or continue decelerating through the first half of 2026 as we kind of work through recovery period for logistics and specialized sectors. But we are forecasting a modest recovery in the second half of 2026. But again, that is barring any unforeseen trade and economic policy disruptions. So what's ahead for the world of industrial here in Chicago? So because we rely so heavily on coastal port activity, we're the most impacted by trade and industrial policy. So we're going to continue to keep a close eye on overall policy, specifically as it relates to the distribution of goods, as changes in policy tend to have an outsized effect on demand for Chicago's logistics and distribution sectors. And around 65% of total industrial space here in Chicago is geared towards that sector. So definitely has a notable impact. We do have a notable amount of supply on the market related to our current demand picture. So until that space is absorbed, you can expect rent growth to remain relatively flat at our current pace of absorption. There's about 5 years of supply that's of a supply overhang. So until we work through that, rent growth will be relatively muted. Across the nation, the supply overhang is currently around 2.5 years, so a bit oversupplied for our current demand picture. But the good news here is that we do have some emerging demand drivers. One of those being data centers. As it stands, we're forecasting about 2.2 million square feet of data centers to deliver in 2026, with an additional 1.4 million square feet to deliver in 2027, and likely more to come. Chicago is poised to be a major player in the data center and quantum computing space. So I think the big question here is how will this impact demand for industrial space moving ahead? So onto the world of retail. Again, I'm going to kick it off with a national trend that is impacting the local market here, which is announced store closures. And that narrative has actually shifted pretty quickly over the last year. So in November 2024, we saw closures outpace openings across the nation by over 25%. There was about 1,400 more closures than openings. And this had a significant impact on Chicago as the likes of Big Lots, Joann Fabrics, CVS, Family Dollar, and Party City, they all had significant footprints here in Chicago, which which impacted our market. Fast forward to the end of 2025, we saw 35 more openings and closures. But one thing to note that I believe is pretty important, there was about 600 less announced openings in 2025 compared to 2024, so about a 10% decrease. So taking a look at supply, demand, and vacancy here in Chicago retail. So we saw supply outpace demand by about 1.4 million square feet in 2025, and that's just due to the Chicago retail market working through the impacts of those store closures in 2024. And this is a notable shift from where we were a year ago, as the market had absorbed about 1.5 million square feet. So that marks about a 3 million square foot shift in demand. And over the last year, we saw about 1.1 million square feet of total deliveries, which marks about a 20% decrease in comparison to the prior period, where we delivered about 1.3 million square feet. Vacancy is about 50 basis points above the national average. So the Chicago market currently stands at around 4.8% vacancy compared to nationally at around 4.3%. So taking a look at where retail demand is coming from. So your strip centers continue to outperform as the tenant mix consists of services that just can't be replicated virtually. So think your hair and nail salons, coffee shops, dry cleaners, laundromats, all those drive foot traffic to these retail centers. And just generally, both locally and nationally, we are seeing space less than 10,000 square feet perform the best of all box types. And that's going to be the typical inventory of a strip center. Taking a look at our overall development activity for Chicago retail, there's currently about 1.1 million square feet under construction. So that's just about 0.2% of our total inventory. For reference, the national average is around 0.4%. And our construction starts continue to remain low as well. But this lack of supply has actually helped keep vacancy and availability in check during this period that I like to refer to as a period of recalibration. And this is again following the store closures that were announced in late 2024, which as a result, it's limiting options for prospective tenants and kind of pushing them to occupy the existing space that's sitting vacant on the market. And just looking ahead of the overall outcast, you can expect retail development to remain relatively low as the rents that are required to make new developments pencil just aren't there yet. Taking a look at availability rate by subtype. So for reference, market-wide across Chicago, we're at about 5.5%. Nationally, we're at 4.8%. We saw availability for the neighborhood centers take the biggest jump over the last year, increasing by about 50 basis points. And malls probably had the highest fluctuation over the last year, but relatively flat at the end of the day. And this is just because malls are more volatile just due to their exposure to some of your larger format store closures. And similar to malls, your power centers fluctuated quarter over quarter, but when you zoom out for the full picture, they remain relatively flat around 10%. And again, strip centers continue to perform well on the heels of continued demand. Strip centers saw their availability compressed by about 40 basis points to their current rate around 6%. And general retail, so essentially everything you can't box into one of these categories, standalone general retail, compressed by 10 basis points year over year as well. Taking a look at rent growth, so market-wide for Chicago, we saw rents climb about 1.8% year over year, and that's on par with the national average of 1.9%. Your neighborhood, power, and strip centers all exceeded the market-wide rent growth rate as demand for your grocery anchored and your daily needs formats continues. But the overall takeaway here is growth is positive across all of our subtypes, but the delta between your community formats, so think your neighborhood, strip, and power centers, and your malls, kind of highlights where leasing momentum and retailer expansion are concentrated. Looking ahead, kind of for the forecast, we're forecasting a deceleration in rent growth to about 1.5% year over year. But again, that remains in line with national trends as well. So what's next for Chicago retail? Again, I don't have a crystal ball, but kind of just based on some of the data points that we analyze, here's some things to look out for. So Chicago still is working through some of those larger format store closures. So the relatively minimal supply underway is helping keep the market in equilibrium. Looking ahead to 2026, we're expecting vacancy to compress slightly, but overall remain relatively flat again. And that's just as prospective tenants work through the available space that exists within the market. And we have seen deceleration in rent growth across Chicago retail since 2022, and we are forecasting that trend to continue as we're expecting to reach around the 1.5% mark year over year, but again, in line with general trends nationally. But we do have some significant demand drivers on the horizon, particularly for our retail submarkets with the highest availability rates, which are all in the loop. So Google's revitalization of the Thompson Center calls for about 2,000 employees to move to the Central Loop, while the LaSalle Street initiative is slated to convert about 2 million square feet of office into about 1,800 residential units. Both of those are tailwind for retail demand as these initiatives have the opportunity to bring some well-needed foot traffic and general life back to the Central Loop. All right, on to the world of office. And again, kicking it off with with some trends that we're seeing nationally here and kind of comparing some of the major markets is return to office. And return to office remains kind of uneven across your major U.S. markets. So nationwide, office visits as of December were we're at about 65% in comparison to 2019 levels, with about a 5% increase year over year. Chicago is among one of your slower recovery markets, as we currently have just about 60% of our pre-pandemic visits. And if you compare 2025 to 2024, that only increased by about 3%. And this kind of just suggests that Chicago's office recovery is lagging and signaling that the hybrid work kind of continues, and which has potential implications for overall downtown occupancy and leasing strategies. And even analyzing some additional metrics such as CTA ridership, that also suggests that some of these RTO efforts across the market are just plateauing. Taking a look at supply, demand, and vacancy for office space across Chicago. So we did see another period of negative absorption as we saw demand losses total about 3.3 million square feet in 2025. But the bright spot here is that we are trending in the right direction. So 2024 saw about supply outpace demand by about 5.7 million square feet. And the market does continue to remove space from the inventory. We saw about 3.7 million square feet of demolitions in 2025 compared to about 1 million square feet deliveries. So a total of negative 2.7 million square feet of net deliveries over the last 12 months. And that removal of inventory has actually been pretty necessary. It's helped keep vacancy from spiking even further due to the negative absorption. Our current vacancy rate stands at around 17.4%, and that's about a 20 basis point increase over the last 12 months. And just for comparison purposes, the national average for vacancy is around 14.1%. And just kind of looking ahead to the forecast for vacancy, we are expecting this to hover around the 17% mark. And again, that's due to limited supply, coming to market in the coming periods. So taking a look at your demand for, by quality, demand for mid-tier assets has been the weakest. We saw three-star office occupancy shift by about negative 1.6 million square feet across the entire market. Then you had your 1 and 2-star assets trailing closely behind, and they saw supply outpace demand by about 1.4 million square feet. And the flight to quality continues, so that while the losses weren't as pronounced for your 4 and 5-star segment, they did see demand losses of about 350,000 square feet in 2025. Just generally, premium space remains the most competitive, but it's definitely still feeling the pressure, while your lower to mid quality assets are struggling to find their footing in this evolving market. So taking a look at supply or under construction, there's not much in the way of new supply being built across Chicago. Currently, just around 800,000 square feet under construction. During the same period a year ago, there was about 1.1 million square feet underway, so that's about a 30% decline year over year. And over the half of the space under construction can be tied to one development, which is 919 on Fulton. That's a 400,000 square foot office development in the Fulton market area that's expected to deliver any day now, actually. So once this asset delivers, there will be less than 400,000 square feet under construction across the entire Chicago market. So taking a look at our vacancy by quality segment. So over the past year, vacancy remained elevated across all our segments, but the pressure is most pronounced in your 4 and 5-star assets, which hover above 22% and haven't really moved much from recent highs. Your 3-star properties stabilize near 16%, which shows some improvement, while 1 and 2-star space holds steady around 7% vacancy. And the gap between your top tier and lower tier assets is kind of like a paradoxical flight to quality. So your demand is going to target your premium space, while excess supply and rightsizing keep that Class A vacancy kind of stubbornly high. Overall, you can expect competitive concessions in your trophy buildings and renewed interest in some of those cost-efficient options, so as some of these tenants kind of balance some of that overall quality with the reality of economics heading into 2026 and beyond. So as it relates to rent growth, we've officially entered negative rent growth territory across all quality segments. So market-wide, we're about negative 0.1%, and nationally, that compares to 1%. Losses have been most pronounced in your 4 and 5-star quality segment, so posting year-over-year rent growth of negative 0.4. 1 and 2-star remained relatively flat, while your 3-star was at about 0.2%. But good news on the way. Looking ahead to 2026, we're projecting a rebound for rent growth across all quality segments, accelerating back towards positive territory and more in line with some of these national trends. As it relates to chunk rents or asking rents per square foot, 4 and 5-star segment leads at just shy of about $40 a square foot, but those rents have essentially flatlined since late 2023. And then there's a pretty significant delta between your 4 and 5-star space and your 3-star space, with 3-star space coming in just over $26 a square foot. And the delta between your 1 and 2-star and 3-star is much smaller. 1 and 2-star rents come in just shy of $23 a square foot. As it relates to leasing, there was about 18 million square feet of leasing activity over the last 12 months. If you compare that to the prior 12-month period, that marks a decline of just about 4%. But if you do compare that to the pre-pandemic benchmark period that we like to use, so 2015 and 2019, leasing activity has declined significantly. So we're averaging from 15 to 19, we're averaging just shy of 25 million square feet. But it's important to note that we were seeing deceleration in leasing volume during this period. So after peaking at about 27 million square feet in 2017, the volume dwindled to about 25 million square feet in 2018, and then to just shy of 22 million square feet in 2019. So post-pandemic, we're seeing average annual leasing volume around 18 million square feet. So 2025 is relatively on par with post-pandemic norms. So, taking a look at, overall direct and sublet availability. So the amount of space available in the market peaked back in 2023 when there was just over 100 million square feet. We have seen availability dwindle by since, but not by much. We're currently seeing direct availability around 90%, and the other 10% is comprised of space made available via sublease. And the persistence of the sublease space kind of just lets you know that there's continued tenant downsizing and overall flexibility in their strategies, even as some of the leasing velocity picks up. And overall, this kind of just tells us that the overall dynamic of the market is, as it currently stands, is a kind of tenant favorable market. So the landlords do face some pressure to compete, not only with those direct vacancies, but with some of those discounted sublease options that are out there in the market. So what's next for Chicago office? We are expecting a rent growth recovery, but not expected to increase dramatically, but an acceleration to take us back into positive rent growth territory. I think the continued question is, have we finally reached the bottom of the office market? That's still to be seen, but Q4 turned out to be one of the most active quarters in quite some time from a transaction volume perspective. So the office world is kind of hoping to take this momentum through 2026. Only time will tell, but as of now, it appears that some of these opportunistic investors, those with agile capital sources, have been the ones that have been most active here in the market. And we have, as I mentioned, we have tons of demand drivers on the way that really have the opportunity to reshape Chicago as we know it. So can Google's revamp of the Thompson Center bring some much needed life back to the Central Loop? And additionally, this has the opportunity to put some downward pressure on the vacancy in the Central Loop as Google occupies the space. And additionally, we're through the LaSalle Street Reimagine initiative, there will be the removal of about 2 million square feet of office inventory from the Central Loop. So what will the impact of that be on overall fundamentals as we remove a lot of that vacant space? And then additionally, quantum computing and data centers have the opportunity to really shape the office world as we know it. And kind of just as a precursor to what we're seeing as of late, we've seen employment figures for the Chicago Metro indicate that we're already seeing the impacts of investments into quantum and data centers as our information and technology jobs have increased at the highest rate year over year across the market. So that is all I have for today. Thank you so much for sitting in on this presentation. I really appreciate it. If any questions, I'd be more than happy to take now.
Thank you very much, Adrian. A very informative presentation on all the different asset classes. I have some questions. If anyone else has any questions, please do raise your hand, and I'll just go in the order of the hands being raised. I would like to ask an overall generic question, especially for those of us that go to national and international events, and we're trying to highlight Chicago. You gave us a lot of very specific data. If you were going to sell Chicago, what would be a few highlights? Like, oh, you should really pay attention to this. Like it used to be for me, like very low vacancy in industrial or whatever. And then, so that's the pro. And where is the biggest risk that you see?
Yeah, so as it relates, kind of a quick elevator pitch. I do think that the strength in Chicago remains overall affordability. So if you compare us to some of the gateway markets, especially as it relates to a multifamily perspective, our rents are approximately 30% cheaper than the average, of all these of the gateway markets. And additionally, a minimal supply across the multifamily market is creating a very competitive rental market, which has been very favorable for landlords, especially as it relates to rent growth. We've kind of been the shining star for the last 2 years. The biggest risk I will say remains in office. The demand story there has been a bit uneven. Just kind of taking a look at some of the return to office figures through Placer AI, taking a look at some of the visits and annual visits and overall CTA ridership, kind of showing a plateau in overall RTO, which again has implications for leasing demand.
And what kind of difference do you see in office demand in the Loop versus in the suburbs?
Yeah, so I would say even within the loop itself, where there's significant nuances. So I would say your traditional submarkets such as the West Loop are reemerging as some favorites, specifically those assets that are along Wacker Drive and with riverfront access. Those are going to be your most competitive Class A plus, and trophy buildings. And we are seeing in terms of suburban leasing, there is it is. I would say not as strong as we're seeing here in the central in the general CBD urban core. There are pockets of opportunities in the suburbs, but I think you're going to start to see a bit more kind of opportunities for adaptive reuse as it relates to suburban office, or sorry, the continued adaptive reuse. You're going to see continued opportunity for some of that kind of flex office space. So R&D operations that had opportunity to kind of take over a campus space. I think Takeda recently, their recent move in the suburbs, they had the opportunity for some lab space, R&D space, as well as office space, kind of all in one. So I think those are going to be some of the bigger demand drivers for office space in the suburbs.
Awesome. Bill, you have a question, and then Peter has a question. If you can unmute yourself.
Yeah, I had two questions. You asked the first one already about office, so I'm going to the industrial flex space in the suburbs. What do you see the vacancy rate, absorption, okay, and construction coming up in the next 5, 6 quarters?
Yeah, so flex is going to be some of your tighter space, and I would say it's probably it is one of the spaces that is in most demand, and that's just due to the overall accessibility, or sorry, convenience of the operation, from being able to have kind of a small office space in addition to some of your more traditional industrial space, within relative proximity to each other. And the pipeline for flex space is relatively thin, especially in your bigger box in your bigger traditionally logistics oriented distribution locations. So think the I-55 corridor, the I-80 corridor. So overall, the demand for flex space remains strong, and the pipeline is relatively thin.
Great, thanks.
Okay, Peter?
Yeah, I'm just curious. You mentioned that imports have slowed by 20%. Is there a reason for that?
Yes, and that is primarily due to shifting economic policy, specifically the impact of tariffs.
Okay. That, one more thing. Adaptive use. Um, in office buildings, I'm in self-storage. I specialize in self-storage. And office buildings are good size. I mean, 40,000, 100,000 square feet, but it seems like they're hard to convert into self-storage. Have you seen that, or have you seen any buildings that have been converted like that? Office buildings?
Yes, yes. So actually, interestingly enough, I was at a industry event last week with the Cook County Assessor Frick Kagi, and he made a very interesting point where um, we are finally in the territory where your Class B minus slash C office buildings are on a per square foot basis. They're trading below, what traditional self storage is trading for. So, he mentioned that there's an opportunity for some of these kind of quote unquote zombie or less competitive buildings here in the Central Loop to be converted or repurposed to self storage. He did highlight, kind of just the self storage would be a bit easier than converting to residential, specifically as it relates to the central loop, as you have to kind of take into account some of the windows, overall livability of these units if you were to convert to residential. So I do think that you may see an emergence of that B minus C plus space that's less competitive, be a candidate for conversion to self storage.
Thank you.
Can I ask Peter, if you were to convert office to self-storage, like what is minimum ceiling height, minimum square footage, and like a price point that you think, oh, then this is worth it for us to do?
Well, ceiling heights, I mean, anything over, I say 12 feet on ceiling heights. And size of the building, it would probably be around 60 to 100,000, 120,000 square feet. And then you have to think about putting elevators in there too. So, I mean, it's not, there's a lot of money to be spent, but if you can buy the building right, it might work out.
Ahmed, do you have a question?
Yes, ma'am. So my question is, I don't know if there's been enough market analysis at this time, but do you see any impact of the tariffs on the commercial in terms of, especially in terms of new commercial development?
Yes. So yeah, we're definitely seeing the impact of tariffs, and I'll provide an example from our heaviest logistics and distribution area. So that's going to be your South I-55 corridor. Typically, speculative industrial developments within this corridor, you'll see a pre-leasing rate anywhere from about 40 to 60%. So before the industrial product even delivers, they have tenants signed up, ready to go. The four projects that are currently underway, over 1 million square feet of industrial product just within that submarket alone, they're currently sitting at around 95% available. So not much pre-leasing demand, and that's just due to some of these logistics and distribution operators kind of either putting a pause on decisions to expand or kind of consolidating their footprint, so no longer need as much space. So that's kind of the broad impact I would say that it has had specifically on industrial. You're not seeing that strength in pre-leasing as much. And that's kind of a trend that we've seen the last 12 to 18 months in result of shifting economic policy, specifically tariffs.
Oh, thank you. Yeah,
Thank you. And Adrian, where do you think is the biggest opportunity?
So I'm a little biased just because I spent some time working, or I spent a lot of time, most of my time, working in housing. So I would say multifamily is one of the biggest opportunities, just given the supply constraints as well as kind of ongoing demand here for the Chicago market, and actually multifamily product across the Midwest in general. The cat's out the bag. The Midwest is a lot cheaper than New York and Los Angeles, so we're seeing some heightened demand. But additionally, I think there opportunity lies within industrial as well. At the end of the day, we are the largest industrial market. We have 1.4 billion square feet of industrial space, and the recent impacts from economic policy. I think they're a bit more highlighted just because 2022 and 2023 were such great years for Chicago industrial that this is kind of this is the trough. But we are, barring any unforeseen changes to economic policy, I think that our industrial will remain relatively strong, and that's kind of, you can even kind of see that through some of the data right now. So logistics demand has slowed down, but it hasn't gone negative. We're still seeing demand for that space, and our rent growth within the logistics space is still relatively strong, outpacing the national average by about 2x. So even in our weakest periods, we're still performing relatively well.
All right, thank you. If there are no further questions, we will end this portion. So it was, we had content, then we had the Q&A. Thank you, Adrian, for the time. After this, we will be ending the recording. But before we do that, not only would I like to thank Adrian and everyone showing up, thanking everyone in our behind the scenes, Deanna, Regal, everyone who makes this happen. And for future months, we especially encourage NICAR members to present, but if you know anyone or have topics that you'd like to see presented, always open ears to hear that. And we also always have the needs and wants session afterwards, so we can help facilitate getting deals done for brokers and or for other commercial practitioners that are part of NICAR, trying to advertise their needs and wants as well. So thank you again, Adrian. I hope you tune in next month. You can already go on NICAR events to see what we have in the coming months. And I hope everyone has a wonderful day. Please do stay on for the needs and wants when we end the recording. Thank you.